Hey everyone, in this video I'm going to look at two companies that are going to benefit from the rising effectiveness of artificial intelligence and answer which one I think is the better buy at current valuations. The two AI stocks I'm going to look at in this video are Broadcom and Supermicro Computer. So without further ado, let's get into this analysis.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, first let's look at revenue for these two excellent companies. And Broadcom is a bigger company at $35.8 billion in revenue. That's come not only with organic growth, but also acquisitions. Supermicro Computer, meanwhile, $9.25 billion in revenue in the trailing 12 months, notably 103% revenue growth in its latest quarter. But let's look at the total addressable market opportunity for artificial intelligence. According to Statista, the total addressable market for artificial intelligence is expected to grow to $1.85 trillion by the year 2030. That would be up significantly from the $207.9 billion in 2023. Artificial intelligence is popularized by large language models like ChatGPT, but there are more applications like driverless car technology, recommender systems, and more. The companies that stand to benefit from the growth in this AI surge is companies like Amazon, Nvidia, Alphabet, Microsoft, and more. Investors getting in today could realize exponential returns from investments that capitalize on the growing effectiveness of artificial intelligence. All right, so now that you have an understanding of how massive this market could be, let's continue with this analysis. All right, the next thing I wanted to look at is operating profit margin. Comparing these two, and Broadcom is well ahead, almost 5 times as much as Supermicro Computer in the operating profit margin, 45.93% compared to 9.4% for Supermicro Computer. I also want you to understand the importance of cash flow from operations. Cash flow from operations is one of the most vital metrics I consider when making an investment decision. If any financial shenanigans are happening, looking at this metric can help uncover the fraud. Moreover, looking at profitability without considering cash flow from operations can lead to a misleading picture of a company's performance. For instance, look at the example I have created here. The company reported a net loss of $250. However, when you look at the cash flow from operations, it was a gain of $35. How can that be? Well, two expenses a company must report on the income statement are depreciation and stock-based compensation. Importantly, these are non-cash expenses. Money is not leaving the company for these expenses. In the case of depreciation, when a company buys a machine for $750, it pays all of that price up front. However, generally accepted accounting principles require that the company take the expense over a period the machine is expected to operate. So if the machine is expected to last for 10 years, the annual expense will be $75 per year for 10 years, even though the company paid the $750 cash at the time of the purchase. Also, when a company offers its employees a stock option, it's not parting with cash. However, it must record the cash value of the option as an expense on the income statement. So moving on to the working capital items, inventory management is the easiest way a company can increase cash flow. The simplest case is when a business has 100 inventory units, sells 30 units, and doesn't replace those units. The decision would reduce total inventory and increase cash flow. As you might already be thinking, this isn't sustainable. Eventually, the company will deplete all its inventory and go out of business. Accounts payable is the money that a company owes another company and has not paid yet. And accounts receivable is the opposite. A company can increase its cash flow by collecting payments faster and paying suppliers slower. If done with skill, companies at scale can take advantage of these timing differences to boost cash flow by a couple of % annually. Costco is one example that employs this strategy masterfully. Overall, if you observe cash flow increasing unsustainably, you should expect a reversal of that trend. The other big risk to consider is if you see a company reporting substantial profits but negative or weak cash flow due to rising accounts receivable. Okay, so now that you've taken a look at that, look at the lead Broadcom has against Supermicro Computer here. 50.49% compared to negative 1.4%. Again, well ahead of Supermicro Computer, and Broadcom is among the leaders of the best of the best in terms of cash flow from operations. Broadcom is right up there. So an excellent cash flow from operations to be sure. Let's look at the prospects for the next few years. Supermicro Computer is expected to grow its revenue by 103% for its fiscal year 2023, which ends in June of 2024, interestingly. And then revenue growth is going to slow down to 33% in fiscal year 2024, and then just 3% in fiscal year 2025. And then earnings per share, similar, 85% in 2023, down to 30, down to 9. So significantly decelerating prospects for Supermicro Computer, even though the next year and a half is going to be explosive. For Broadcom, 39% revenue growth for its fiscal year 2024, which ends in October, 10% revenue growth in fiscal 25, and 8% in 26. Earnings per share of 10% growth, 20% growth, and then 10% growth again. So more consistent growth, but less explosive growth from Broadcom expected over the next 2.5 years. And finally, let's take a look at the forward price to earnings ratio valuation comparison with Broadcom and Supermicro Computer. Supermicro Computer, given its surge in stock price to start 2024, is trading at a forward price to earnings of 31, which is more expensive than Broadcom of 22.6. So given how excellent Broadcom is in terms of operating profit margin and cash flow from operations, and given how Supermicro Computer's explosive growth prospects are going to slow down in about 1.5 to 2 years, if I had to pick between these two AI stocks for the long term, I would be picking Broadcom stock right now. Broadcom would be my choice because of its better profitability, better cash flow, and the cheaper valuation. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.